Bonds, James Bonds. No, unfortunately, this is not a video about a British operative who lives no matter the scenario. It is, alternatively, in fact, a discussion about bonds as an investment option in your overall financial picture. That, of course, is discussed much more fully in Chapter 8 of our book, Next Gen Dollars and Cents. But simply put, a bond is a loan made by an investor to earn interest income and ultimately preserve capital. The bond issuer, the person that issues that bond, promises, courtesy of the bond document, to pay regular interest to the investor and then, at a specified maturity date, repay that loan's principal amount. So effectively, a bond really is a version of a loan. So bonds themselves are issued by various entities like governments or corporations to finance the construction of bridges or roads or manufacturing plants or ongoing operations. And at the end of the day, bonds, in comparison to stocks, which we talked about in our Chapter 7 video, provide investors with a more stable source of income, courtesy of those interest payments that occur on a regular basis. And at the same point in time, from a public need perspective, they're certainly responsible and the main technique, if you will, for funding public projects and generating extra corporate growth, because you're borrowing money, which then winds up being a part of being able to then use that money to grow and to construct different types of projects or manufacturing plants or bridges or roads. The world's largest issuer of bonds is, of course, the good old United States government. Perhaps these days they are issuing about too many bonds, but that's probably a different video altogether. Currently, the U.S. government has over $24 trillion in outstanding bonds. In comparison, on the corporate side, Microsoft, the largest debt issuer worldwide on the corporate side, with $64 billion outstanding. So U.S. Treasury, $24 trillion, largest government issuer. Microsoft, the largest corporate issuer, with a mere $64 billion outstanding, which really underscores kind of this next statistic that we talk about in the book. And that is that the bond market itself is valued at over $300 trillion globally. And what people don't realize is that the bond market is actually significantly larger than the global stock market. The global stock market capitalization is only worth about $125 trillion. So the global bond market, in terms of value and the amount of face value of these bonds that have been issued, is approximately 2.5 times greater than the global stock market. And obviously the United States, significant player in both markets. U.S. accounts worldwide for about 40% of the bond market and about 42% of the equity markets. Bonds themselves typically classified into 3 distinct categories, effectively based on who issued the bond. So Treasury bonds issued by the U.S. federal government, considered low-risk investments because it has the backing of the full faith and credit of the U.S. government, and also its taxing authority too. Municipal bonds are typically offered by local and state governments to fund public projects. The interesting part about these bonds is that they do provide, their interest payment is tax-free on federal tax returns. So oftentimes you see those types of municipal bonds being attractive to investors in higher income brackets when it comes to their after-tax money. Obviously, that doesn't work inside of an IRA, because everything you take in outside of an IRA is going to be fully taxed as ordinary income. That's why you wouldn't typically see municipal bonds inside of a retirement account. That would be kind of weird if you if you saw that. And then lastly, the third category in terms of issuer, corporate bonds. Those are, of course, issued by companies to finance operations, generally viewed, as you might well imagine, as riskier than government bonds. But for that, then they typically offer higher yields. And when we talk about yield, a bond yield effectively is the investor's return for that investment. If a bond offers to pay, say, a coupon rate of 7%, then the issuer is offering an annual return of 7% on that loan. Obviously, a 7% yield indicates a higher annual return on an investment than, say, a 3% bond yield. Higher yielding bonds, of course, imply increased risk, right? If you're issuing out a bond and your pricing is coming in at, say, 7% or 8% versus, say, 3 or 4%, then ultimately you're offering that higher interest rate to attract investors because there is a little bit higher concern of whether you might default on that future payments. And so that's the trade-off. Higher interest rate means a little bit more risk. Lower interest rate, less risk in terms of the actual issuer of that bond. So one of the things that sort of determines those interest rates that apply on a bond issuance is bond credit ratings go to assess the creditworthiness of a bond issuer. So they evaluate an issuer's ability to meet their financial obligations. Those ratings, typically assigned by credit rating agencies such as Standard & Poor's and Moody's, involve an in-depth analysis of the issuer's financial health, industry position, along with various economic factors. So that's how you determine sort of what the creditworthiness is of a particular issuer based on kind of what these agencies have determined is the valuation or the rating of that particular issuer. The current interest rate environment certainly plays a very crucial role in bond pricing. Current yield on a bond is inversely related to its price. So when interest rates rise, bond prices generally fall and vice versa. If you think of it this way, in a higher interest rate environment, investors have more options to get a higher yield on a new bond, which then decreases demand for existing bonds with yields based on what would have been a lower interest rate environment. And so this reduced demand generally causes the price of existing bonds to decline. So that's how sort of the interest rate and the bond price sort of vary inversely. The notion of bond maturities is simply the date at which a bond's principal is repaid to the investor. So that could be range from a short term, say less than 3 years, 1 to 3 years, or long term, which would be considered more like a 10-year period. As with any investment, right, bond ownership has various risks, things like credit risk, which is the likelihood that a particular issuer may default on a bond, inflation risk, which pretty much always there on any investment, that relates to the potential erosion of the purchasing power of those dollars. And then, of course, interest rate risk, right? A change in interest rates can certainly affect bond prices. So overall, bonds are certainly an essential investment vehicle that provide a predictable income stream with lower risk compared to stocks. And so every portfolio should generally have some portion. Obviously, if you're older and more risk averse, then that's going to be more versus someone who is younger and less risk averse than say an older individual or someone closer to retirement. Chapter 8 of our book also includes or concludes with a discussion of sort of a separate discussion on U.S. Treasuries. Remember earlier in this video, we talked about the U.S. government being the world's largest issuer of bonds with over 24 trillion outstanding. Generally, treasuries are viewed as providing a risk-free return because effectively they're backed by the full faith and credit of the United States government, considered the most creditworthy in the world. The yield, though, to be clear, offered on U.S. Treasuries affects both financing rates from mortgage rates to car loans, and also affects savings rates, what you're getting in your CDs, money markets, and things like that. And certainly long-term U.S. government securities, primarily Treasury bonds, have experienced a bit of fluctuation over the course of the past 60 years, from the peak in the late 70s, where those Treasury rates moved up to about 15%, to 2020, when that 10-year yield actually dropped below 1% for a period of time. Certainly a combination of economic conditions, monetary policy, what's going on in the rest of the world, certainly shaped the performance of long-term U.S. government securities. But those events and their impact on Treasury yields certainly directly impact your finances, no matter whether you own bonds or not, because they have that impact on the cost of borrowing and what your current savings rates is. So to get an even better understanding of bonds and how they work, be sure to read Chapter 8 of our book, Next Gen Dollars and Cents. You can get a free copy of your book by texting free copy to 407-791-0070. That's 407-791-0070. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of Next Gen Dollars and Cents. Thanks for watching this video.